Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome back to Surgeon Syndicate. This is your host, Dr. Michael McManus, and we are here today with Michael Holdwick. And we're going to jump back into our conversation as we're discussing some of the merits and really the boom going on in Detroit right now. Yeah, so Detroit, I'd read about there were some really big projects going on downtown Detroit. Is there new industry? I know a lot of the Midwest right now is, it's the one place that really hasn't boomed in the last 20 years. And so the cost of living is lower, the cost of doing business is lower. And it seems like now, and I think this is a pattern sometimes when economic times change a little bit, is that the Midwest, that's when the Midwest booms. I've a good number of people that in my network were in Cincinnati, and it seems like that most of Ohio is really doing great. Are there new industries? What's, at least how much of the auto industry is still there? What kind of industry is driving Detroit right now?
Yeah, I would say coming out of the Great Recession, I think there was a very hard lesson for Metro Detroit because it was so focused on the automotive industry, right? So I think that basis is still there. The big three, Chrysler, GM, and Ford, are all still headquartered here in the metro area. But I think the big change that drove a lot of the growth was actually the mortgage business. So Rocket Mortgage and Dan Gilbert's family of businesses are headquartered in Detroit. And he really went on a buying spree in downtown Detroit. And he did two things. He said, I'm going to set up my business in this area where I can get really good value add city center real estate. I'm going to bring young people into the core and employ them. And then I'm also going to buy the buildings that they want to live in. So I'm going to have my businesses in these buildings and I'm going to have my employees in these buildings. And I'm just going to create an ecosystem of myself. And he built partnerships. It wasn't just Dan Gilbert, but others kind of bought into this idea of bringing that life back to the core. All the sports teams moved back downtown. So they're all there. And it just created a vibrance in the downtown that really wasn't there for 20 or 30 years as the flight of population kind of moved to the suburbs. And then United Wholesale Mortgage, they're the biggest wholesale mortgage company and, second biggest mortgage company in the nation. They're based in the suburbs of Detroit. So I think the banking diversification, even though it's not doing great now because of rates, through the COVID wave and before and after that, there was a huge boom of mortgage applications and mortgage closings that really drove those businesses too. So I think adding that diversification on top of a strong manufacturing base is there. But I think there's also a lot of macroeconomic factors that are bringing manufacturing in particular back to the US, right? And I think that's why you're starting to see some of these Midwest markets really get in vogue again. Like you mentioned, Cincinnati, Columbus, Cleveland, and Ohio are all on the upswing. I think Detroit and Grand Rapids and Michigan are really strong. I think you're seeing some good growth in Indiana and other markets like that, and Wisconsin certainly. So I think you're seeing that core of the Midwest kind of combine new businesses with their legacy businesses, and the onshoring of manufacturing is kind of driving the demand of a lot of the industrial properties, especially.
Yeah. Who would have thought 15 years ago that we'd be talking about industrial manufacturing coming back to the US?
Yeah.
And that's a really interesting, here in Green Bay, most of it's toilet paper and cardboard. So that stuck around.
Yeah. That was in high demand during COVID.
I still remember when we couldn't get toilet paper here, and I'm like, we've got like 4 giant toilet paper manufacturing plants. How can we not get toilet paper? You're like, man, it's bad if you can't get toilet paper in Green Bay.
Yeah, it's like not being able to get sand in the desert,
That's the way it felt. So now you've mostly transitioned. Do you still own any multifamily, or have you completely or residential moved out of that?
Yeah, let me bring you to present day. So I currently own 6 commercial buildings. The medical office that I talked about, the first building, the radiology practice, the newest medical office, which has 2 general practitioners, and then also an Edward Jones tenant in there. So it's a 3 tenant. They're all on long-term leases. Edward Jones actually corporately guarantees their local branch leases. So that's a really strong lease as far as financial advisors go. So the 2 medical buildings. I have 2 professional office buildings. One's a 10 suite and one's a 7 suite. So those are, like I said, the professional building down the street from your subdivision that has your insurance company, your psychologist. I have a hairdresser in one of them, attorneys, financial advisors, things like that. I have the light manufacturing building that I talked about. So we have a tenant that does food production. So they import spices from India, blend them, package them, and ship them out of a 9,800 square foot light industrial building. And they actually sell them on Amazon. That's shipped direct to consumer from their warehouse that they rent from us. So yeah, and then I have one strip mall too. So it's a very diverse portfolio of commercial real estate. I'm asset agnostic. So I don't necessarily look for one asset type because I think there's strength in that diversity, especially coming out of COVID, because black swan events can happen and quickly disrupt any given asset type. But I really like, the neighborhood value add type stuff. And there's yield there. We find deals, if you source them right and buy them right, that could be 15-20% ROI type stuff.
So what's your secret sauce to sourcing good deals? Is that the corporate secret, the formula for Coca-Cola?
No, I think being an engineer, I'm a spreadsheet guy. So everything needs to pencil, right? So I'm big on the front end, the underwriting of the deal, finding a good property, and if it looks good on paper, I'm not afraid to turn over all the stones, right? And find out where the skeletons are hid, if there is any, and really get to the bottom line of what the numbers are going to look like and paint the picture for myself of what that property is going to look like on a 5 or a 10-year basis, right? So I wouldn't say there's any one secret other than we evaluate a lot of deals. There's 1,000 no's for every one yes. And then even when you get a yes, you'll get it under contract. We'll put some soft money down. We'll start to unfold the deal, do the environmental property condition assessment, dig through the property records, talk to the local municipalities, and a lot of those become no's too, right? Because we're very picky on the deals that we move forward with because we want them to be very strong for the long term. So I don't know if there's one thing in particular that's really the special sauce other than have a good source to find deals and then know what a good deal looks like just based on your experience, and really invest a lot in that front end, because the more that you invest in the front end, the less you're going to have to invest in the back end, right? Because if you have a loser property that can't go good tenants and has continuous problems, it's just going to be pain the entire time that you own it.
Well, that's part of the great thing about when you get into the non-residential multifamily spaces is your operational risk on the backside is a lot less. That it's so much more of it is front loaded on how you get the deal to the finish line and whether you've got tenants ready to go for your value adds. So I'm talking to a lot of doctors, and I know not all our listeners are doctors, but when we start, this is a space that for a lot of them brings out more fear, more anxiety. And I think we've talked about this on the show before, that we've all rented an apartment at some point, but most of us, a lot fewer people have rented retail space, maybe office. Hardly any of us have rented industrial space. What would you say to those people? Somebody's like, no, the multifamily folks say, well, everybody needs somewhere to live. So that's why you should invest in multifamily.
They do.
What's your argument, for why this is a preferred asset class for an investor?
Yeah, I think there's a couple different reasons. And the first I already mentioned, I think it's really the strength of the buy, right? So I'm a guy who likes security. I like backup plans. I like backup plans for backup plans. and my backup plan is always to be able to win that race to the bottom, right? Because real estate's a commodity and it's a market, and it's based on 2 things. It's based on condition and it's based on price, right? So if you have a property in a good condition that you can offer and still make yield at a lower price than your competitors, that property will be rented, right? Because that's going to be the first call if you're the best rate and the nicest property. So I really like to focus on the cost basis. The other thing that I love about commercial real estate and buying existing buildings that are value add is you're buying those properties at a fraction of the cost that they can build a new one at, right? So your other threat, your other competitor to oversupply, or if there's less demand one day, is a new build. But when you look at the cost of construction, they're building office buildings or new retail buildings at $250 a square foot, and I'm buying them at $50 to $100 a square foot. My cost basis is so much better. And proof of that is I own the strip mall on a main highway. So it's a 5-lane divided highway. 25,000 cars go past it every single day. I have the strip mall on one side of the road, and on the other side of the road, they just built a brand new retail building. The brand new one has 0 tenants, completely vacant, has been that way for 2 years. Mine, full. The difference is my rent price is half the price of the property across the street, right? So I think the proof is in the pudding there that you can always find small businesses, people that need your real estate to make their living. So in this case, a dog groomer, a photography studio, a lady that actually has equestrian services. So she repairs and washes horse blankets, which she needs industrial dryers for. So I have a flex space that she has a long-term lease in. Those people need your property to make their living, and they're going to go to the property that best suits them. And cost is a big piece of that. So if I can offer the best cost, I will have tenants.
That's great. So when you're talking to investors, you do syndicate your deals.
Yep.
And bring in investors.
Just starting to get to that point. That's kind of like the next chapter for us, because before it was more about building my own real estate portfolio and building that snowball, residential deals to commercial deals to bigger deals with 1031s and adding that value, getting the tenants, doing the improvements. But now I really want to kind of turn the page and reach out to investors, people who are interested in value add commercial, neighborhood type stuff, because I feel like we have the framework with strong property management, strong deal sourcing, strong underwriting to be able to bring other people into that fold. So we're actually doing our first syndication right now and setting up a second one as we speak. All
right. So what type of property? We'll give you this like a promo moment because it led into it so well. Unless if we want to make sure if it's a 503B, we don't promote it too much. We'll just give basics. But so what type of property class is this deal?
This one's an industrial deal. It's a 30,000 square foot light industrial deal that was a former manufacturing facility that we're actually buying on spec. And our plan is to multi-tenant it. So we're getting it at an exceptional cost per square foot for the market. It's a really strong market. And we're buying it at under $20 a square foot. And our rent pro forma's at around $5 a square foot, triple net, if not higher. We like the upside of industrial. So that's about as much as I can say about it.
Okay.
But, yeah, we're going through environmental right now and just kind of buttoning up a few final things, and then we're going to be coming to a close here shortly. But again, huge value add opportunity, and we love the long-term prospects of industrial because there's just so many uses. And those uses are zoning limited, right? And it's the ultimate not in my backyard. I don't know when the last time a community rezoned parcels to industrial, right? So there's fewer and fewer parcels, fewer and fewer buildings, but more and more uses. So I think those two macroeconomic factors are really going to drive the demand and the prices ultimately of industrial real estate, especially the class B and C stuff that they're just not making any more of. They're building the bigger class A, higher ceilings, but this stuff is small business stuff.
What do you see as the biggest risk in a project like this?
I don't see a lot of risk because we acted quickly on the property, and there are so many people in line behind us to buy this property. So I think if we close on it in our business model to multi-tenant it doesn't work out, I think this is one of those properties that we could probably even just sell back to the market as is for a small profit, right? That'll make it worth our time. So I think from like a sale and financial risk standpoint, it's low. I think the riskier sides of it are the environmental side of it, right? Because a lot of industrial properties either had manufacturing uses or adjacent manufacturing uses, right? So you really need to pay attention to your phase one and your phase two environmental site assessments to make sure that you understand what you're buying. And if there is environmental liability, mitigating that through doing the proper documentation with the state. I also think there's long-term risk in just the cost of improvements, like any property right now. To replace a flat roof is, a small fortune. So you got to really underwrite your deals to know what your deferred maintenance is, your parking lots, things like that, and build those into your pro forma. Because if you ignore those, you could have a $50,000 or $100,000 price tag that you don't anticipate, and that makes your IRR look a lot different.
So if a doctor comes to you and says, Mike, I think I like this idea of investing in industrial. Yeah. What would you tell them are the key things that they need to do in evaluating a deal before they write a check?
That's a good question. I think understanding just the basic fundamentals of the market, right? So where the lease rates are at versus your purchase price, and you want to make sure that it just pencils at a basic level. So I think that's first and foremost. I think you also want to understand the amenities that your industrial has. Power, for instance, having a good source of phase three power, multiple sources of phase three power is really attractive to tenants. Truck docks, loading docks, overhead doors, having that flexibility of the building, higher ceilings, those amenities can really have a high influence on what your rental rates can be. So understanding those are really key, I think, to coming into an industrial deal. But I also want to talk about the tax advantages of industrial deals. I know I've heard you talk about the tax advantages. Also, for people who have high net worth, you're always looking for tax offsets. And I love industrial deals from that standpoint, because we're still in an era of bonus depreciation, right? Even though it's just 60% bonus depreciation. And I love doing cost segregation studies on industrial properties that have a lot of equipment, because that allows you to bring a lot of that depreciation that normally would be on a 39-year schedule up to year one. And then you can use that to offset other income sources or other taxes from income sources. So love that part of industrial.
That's awesome. So, and that would be an industrial building that's not just a big blank shell, but it's coming with some equipment, because that's the part that the cost segregation really picks up on.
Yeah, absolutely. I think the electrical equipment, the mechanical equipment hits really strong in that sense. So even some buildings that are just essentially a shell with heavy duty electrical, a lot of bus systems, electrical drops, mechanical systems, air handlers, stuff like that, that manufacturers could potentially use. All that stuff is really valuable.
Awesome. So before we, I'm just going to pivot off of the industrial, because I know you said you owned a good bit of office, and maybe some of it's retail too. What are your thoughts on office right now, and what office maybe is still appealing versus what's not appealing?
Well, I can tell you, I got flat lucky coming out of COVID, because I think if I was at a different place in my real estate investing journey, I probably would have been pursuing big office, potentially even city center office. But I think the big loser of the COVID experience was that big city center office, right? You're seeing a major pullback, and you can't look at the news without seeing a headline about Chicago or San Francisco or other markets like that, where in this work from home era where people aren't forced to come to the office, companies are downsizing, they're letting their leases expire, and a lot of those buildings are on shaky footing as far as their cost basis versus debt service. I love suburban office, the local office, because what I found with the two that I own is that attorney still wants a suite within 5 or 10 minutes of his home where he can meet clients. He has a separation from, his family or his dog, or just that mental separation of having a space to meet, a small conference room. Those under 2,000 square foot office spaces that are well located and in good condition, all the way down to some of my suites are just a few hundred square feet. So it's more of an executive suite. And really, those businesses just use them for the business address because they don't want their home address on the internet, and it actually costs less than a PO box in many cases. So I think I'm very bullish on suburban office, especially stuff that's Amazon proof, work from home proof, and recession resistant. So we're looking at another deal right now that has a physical therapist, a title company, a dentist, a massage therapist, beauty salons, a pregnancy help center. Stuff like that is always going to need office space. That stuff isn't going work from home, and it's not going to be put out of business by Amazon. So that's the stuff that we're really focused on right now. So that's kind of my take, big picture on office space.
Are there any particular things about suburban office, any, I don't know, location, amenities that make you like a suburban office better than another one?
Yeah, I think from an owner standpoint and a tenant standpoint, obviously the property condition is king, right? So I'm looking for brick buildings or mostly brick buildings, something that doesn't have to be painted and doesn't have to be resided over time, right? Something with, roofs are very expensive, flat and asphalt roofs right now. So I don't want too much roof. And if I get a roof, I want it to be in newer condition. Parking lots, roofs and parking lots are the big thing to me right now. Mechanical units, really evaluating if there's a lot of deferred maintenance there and what that looks like over the next 5 or 10 year horizon. And then as far as on the tenant side, it's proximity to nice areas, right? Because nice areas attract high-end clientele and they also attract high-end tenants, right? People want to work and live in nice areas. So we're looking at affluent suburbs that have attractive office buildings. And the cool thing is that these suburban office buildings are kind of like coming down the slope with all the other office buildings, but I think the value is still there. And the ones that I own, that the rents are increasing. So like, as leases expire, I'm proposing higher rental rates and my tenants aren't flinching at the higher rental rates right now. So it's actually, driving the net operating income up, which is, forced appreciation for me. So I'm bullish on suburban office building if you can find the right tenants and the right asset.
That's really interesting, that being drugged down with everything else, because there are a lot of investors who you mention office and they're just out immediately.
No way, I'm out, right? That's what you'll hear. Like, no way, it's being typecast with all the other city center office stuff. And I think the headlines are just running it down. And I'm seeing nice office buildings below $100 a square foot, some $60, $70 a square foot. But those spaces are renting for like $20 a square foot. And some of those leases have a net on them or two. So common area maintenance or utilities are paid for and things like that. So just the broad numbers right there. If you can get $15 to $20 a square foot on a property that you're purchasing for 60 to 80, your ROI could be scratching 20%. And you're not finding that anywhere right now.
Yeah. And those are all they're smaller office spaces. Yeah. Because I was looking at a couple that the owner at this point really wants to sell them, but part of it could be divvied up into smaller spaces, but part of it is big, lots of cubicles and that kind of space. And that's a lot more work to try and lease out to smaller individuals, which sounds like where you've had your success.
Yeah, definitely. I think if you have vacancy, you want it to be under 2,000 square foot per vacancy. If you've got one huge area that you're going to have to sink a bunch of money in to subdivide 8 or 10,000 square feet, that's going to be a little bit harder sell unless you come into it with a tenant. But that's another way to mitigate your risk is line up the deal. And then through your relationships with brokers, try to line up the tenant and create the marriage before the wedding day, right? So you don't go into that deal with, okay, well, I'm coming into it, but I have 5,000 square foot of vacancy and that's at $20 a square foot. Well, that's $100,000 in cash flow. So if you can bring that tenant to it, even if you need to give them a preferable deal and inch it up over time, I mean, that's a no-brainer. That's what you want to do.
That's awesome. So anything else, as we're talking to docs here who might be dipping their toes in here for the first time, that would be your recommendations if they're starting to look to invest in this asset class that maybe is a little less comfortable?
Yeah, I think it's just finding an operator that has the experience and understand these types of asset classes, because I think what's going to happen, if I had to predict, is people are going to start, these syndicators that have kind of made their living on doing multifamily, right, over the last 5 or 10 years, and they compressed cap rates down to 3 or 4%. And now what they're really finding out, that their business model was an interest rate arbitrage and an inflation arbitrage, right? Interest rates were exceptionally low, so you could leverage that interest rate. Inflation was exceptionally high because of all the money that was printed during COVID. So rents were going up. And now that those two things are stabilizing, I think what we're finding is these multifamily deals aren't as attractive as we thought they were. And there were a lot of overly optimistic pro formas. Those people are going to start looking for other ways to make their money. And I think you're going to start seeing people coming in to the value add commercial asset class outside of multifamily, because they're going to be looking for their yield. They're looking for their fees so that they can put food on their table. So just be careful. Make sure you're partnering with somebody who understands this type of asset class, understands how to create value in this space, and knows the good properties from a property that might look good on paper, but isn't necessarily very good long-term investment.
Awesome. So if somebody wants to get a hold of you and learn more, what's the best way to reach out to you?
Yeah, so I'm new to the social media. I've been really busy over the last 11 years raising a couple kids and chasing these value add deals, and also running with a day job. So I haven't had much time to put myself out there. So that's why I really appreciate this opportunity so much. So I'll plug social media first. Larry and I, my business partner, our business is called Pro Team Commercial. We're based in Metro Detroit, and you can find us on LinkedIn or Instagram at Pro Team Commercial. You can also find me personally on LinkedIn at Michael Holdwick. So those are really great ways. Or if you want to just get straight to my inbox, I'm Mike at proteamcommercial.com. So those are the best ways. Any of them work. I'm pretty responsive and active on all those channels. So I just want to talk to people. If people want to learn more, if they're interested, but now is not the right time, or if they have experiences they can share, deals that we could partner on, I'm kind of open to the networking and the opportunities that come along with that.
Awesome. And we'll try and get all your social media and your email there in the show notes so people can refer to those later. Well, Mike, thank you so much for being on the show. This has been great. I think you've added some really great value to our listeners, and maybe we'll have to do this again sometime. This has been a great discussion about Midwest commercial real estate.
There we go. Midwest, stand up, right?
That's all right. All right. For everybody else, thank you for joining us here today on Surgeon Syndicate, and we'll see you next time. This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.